First is that investment-grade credit offers higher quality yield in an environment when global yields are low. Longer-term defaults in investment-grade credit tend to be very low, so investors can capture a significant proportion of that yield in investment-grade credit. Second is tied to diversification. Investment-grade credit tends to be less correlated to other investments like stocks and higher-yielding credit that investors might have in their portfolios. And then third is lower volatility. Investment-grade credit has a volatility of around 4 to 5% compared to around 15% for stocks and 8 to 10% for higher credit risk-oriented strategies. Thus, we believe investment-grade credit, through lower volatility, through diversification, and through higher quality yield, potentially offers significant value in client portfolios. We think it's extremely important to be an active investor in investment-grade credit. Active investment can help avoid shortcomings of passive benchmarks. Passive benchmarks tend to be debt-weighted, meaning the more levered the company is, higher the exposure is in a passive investment. Active investment can focus on sound bottom-up research to identify companies that go into the portfolio instead of relying on the debt outstanding in the company. Active investment can also help benefit from structural opportunities that come with the size of the issuers or the individual companies.
PIMCO's Edge in credit really revolves around its long-term approach, its depth of resources, as well as its access to issuers. First, we have an integrated long-term investment strategy, which focuses on top-down and bottom-up. Our second edge in credit really comes from the significant depth and breadth of our global resources. At PIMCO, we have 130 analysts and portfolio managers, and a dedicated asset management in credit of $600 billion across both public and private credit. Lastly, we have significant access to issuers in terms of our ability to engage and partner with companies around the world to find unique solutions that smaller firms simply cannot do. We see three main opportunities today, and I'll go through each of these separately. Number one, in COVID recovery, consumer service sectors. For example, we like owning airlines, cruise lines, concert and theme parks, particularly as the consumer transitions from goods to service spending. Secondly, we continue to like real estate. Real estate is really a hard asset. It's also an inflation hedge. Specifically, we like owning REITs, apartments, lodging, timber, and building materials. And lastly, third, we continue to like owning banks and financials. This is really a pure play on cyclicality, as well as the consumer and asset quality.
We think there are a few key takeaways for investors here. First is that investment-grade credit, through higher quality yield, low correlation with other investments, and low volatility relative to other risk assets like equities and higher risk credit, potentially offers a significant value in client portfolios. Second is that active management can potentially offer under 250 basis points of excess return in client portfolios. And then third, PIMCO, through its sound bottom-up credit research with the help of a robust top-down macro process, is uniquely positioned to offer that value to clients in investment-grade credit.